Hello, good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain. With me is Aisha Faridi. And for now, the market continues to be very sideways throughout the trading session. We have been meandering in that 19,300 to 400 range. It's the day of the weekly options expiry, but we are not seeing any big move as of now. 150 point cut is what we are staring at. When it comes to the Nifty, though, the broader markets are outperforming. Banks, they have been the pressure point for the last 5 to 6 trading session. Today as well, they are down, and this is coming despite the strength that we are seeing in the public sector banking names. In fact, public sector names are the only ones which are actually holding in the green. The rest of the sectors are actually in the red. It's the heavyweights which are dragging the index, whether it's the Reliance, which is down over 1%, ITC, which is seeing a lot of weakness today with a cut of around 2%, or even the private banking names, the likes of ICICI Bank, HDFC Bank. They all are putting pressure on the markets to the tune of around 70 to 90 points at the index level. So that really remains a pressure point. Though on the other hand, you have Adani Ports, which is outperforming quite a bit. That stock is holding up with a gain of around 3%. It's also the global markets which are actually not able to make up their mind. The European markets have started off pretty much flat for the trading session. Asian markets were a bit lower. If you look at the US futures, they are holding very mildly in the green. So there's not a lot of Q coming in, from across the globe as well. And there's just lack of news flow, Aisha. There's even at the stock level, there's of course a few stocks which are reacting to news flow, but there's no specific sector or no specific news flow which is driving the market.
Yeah, there's no particular trend that you can really pinpoint. Of course, led by Adani names. Infrastructure is one sector which is holding out. But besides that, there's not much of a material move. Even pharma, which has been finding favor in the market of late, that's underperforming today. Oil and gas, cement and metals once again are succumbing to selling pressure. That said, some of the individual names which are the high flyers, Bata, and I must pinpoint that stock, that's holding up nearly about 6%. A lot of the media reports are indicating that perhaps there could be a possible tie-up between Bata and Adidas, and that's the one stock which is holding out very well in trade. Not Shriram Finance, if we could just bring up the intraday graph of Bata, almost 6% higher. Shriram Finance, of course, is the other one. UBS has come out with a note. They've initiated coverage with a target price of 21.85 on the stock. They're saying NIMS compression is only transitory for this one, and the market underappreciates the EPS growth potential when it comes to Shriram Finance. So that stock is higher by about 2% as we speak. REC, this has been quite buoyant of late, along with PFC, and the analyst call takeaways as well. The fact that they are targeting to be net zero NPA by end of 2025 is definitely instilling some amount of confidence in the street. Almost a 5% uptick is what you're seeing on that particular stock price. And of course, Nava continues to be under pressure. The business interruption in Odisha clearly not auguring well for them. But that said, yes, like Anisha mentioned, you can't really pinpoint any trend in the market. So let's take it across to our chartists and figure out if they're able to do the same or not. We have with us Rudra Murthy joining in on the show, Naresh Mirani, and on the fundamentals we have Sandeep Sabharwal as well. Naresh, let me quickly come to you. What trend do you now see for the index? Quiet start, but we've softened about 100 odd points.
So the trend has been, we are still struggling in this range of 19,300 to 19,600 now. And at the same time, we are not seeing a downward drift in the broader market. So we've not seen the mid cap or the small cap indices take a hit today. So overall, we continue to be in this tight range. Once we start breaking 19,550, 600, then we start getting into a momentum on the upside. Below 19,300 close, it becomes a little negative. So right in the middle of the range, looking at stock specific positioning is more better. So we've seen paper stocks do well. So keep looking out for such sectoral rotations.
What about you? What do you make of the market setup, especially on the Nifty Bank, which continues to be the weak link really, because for 6 days on the trot, it's been on the declining trend, and today it's the private banking names which is pulling that index lower.
Yeah, even for me, definitely Bank Nifty is relatively weaker compared to Nifty, but definitely coinciding with levels what Naresh mentioned. Even I feel Nifty around 19,250 is the range on the downside on Nifty future, and on the upside it is around 19,650. So it is a 400-point tight band within which Nifty is trading, and I feel being very far away from the upper band, which is 19,650, there is likely chance that we might give up on the downside. but let 19,250 break before I start initiating shorts aggressively. But this market is definitely showing that signs of tiredness, even though it is holding that range on the downside at around 19,250 to 19,300. But for me, banks are relatively weaker to short compared to that of Nifty.
So that's the take coming in as far as Nifty Bank is concerned. Definitely the weaker link of sorts. But let's welcome on board Sandeep Sabharwal as well. The one space which is definitely outperforming for now is the entire defense pack, right? And especially the shipbuilding names, the Cochin Shipyard, Garden Reach, Shipping Corporation of the world. Do you think these are just one-day moves that, you know, keep on happening on account of momentum, but it's not really an investable universe?
The
Sandeep,
shipping corporation doesn't really have too much of story, but I think the other shipbuilders do have stories going for them, and the recent announcements by the government of further augmenting the shipping fleet, possibility of these companies getting more orders. So I think all that is a reality. These are relatively, in the context of the overall market, these are relatively small companies. So to that extent, whenever interest comes in such small companies, we've seen that the price movements tend to get exaggerated. So I think that's something which will keep on happening. Directionally, next few years, the stories will still play out. In the near term, stocks obviously overshoot, then they give correction. So I think people need to be careful, especially who have a short-term horizon, need to be careful when they buy, because at any point of time, 10-20% kind of fall can happen in many of these stocks.
Sandeep, on an overall market basis, I wanted to understand what is it that you're making of the FII trend? The fact that they've been buyers of late, but buyers only in big blocks. I mean, cases in point being a JSW Energy, or for that matter, Adani names, and not really buying the overall market, so to speak.
Yeah, so I think that buying we can't put in FII buying, because those are specific incidents of purchases by specific funds and specific companies. Overall, the trend has been weak in terms of foreign investor flows and could remain weak in the near term as the dollar remains strong. And then there are some concerns on China, etc. Because see, what happens is that a lot of the flows tend to be from emerging market funds, and to that extent, when the other markets are not doing well, then when the outflows, then India tends to also get some outflows. So near-term picture for foreign investor flows is hazy. And I think once over the next few weeks, as things play out, as the dollar index sort of peaks out from this short-term kind of rally which is staging, and as yields peak out, then we'll see funds flow start again. So, but in the near term, I think it could remain weak.
So that's a take coming in as far as some of those stocks are concerned. But Sandeep, do you track VIP Industries closely? Because the earnings were rather bad. There was a resignation at the leadership level as well. The stock or the company has been losing market share, but the stock had been holding up okay, at least if you look at a bit of a long-term chart. What's your view on this versus Safari?
So Safari obviously has done much better than VIP over the last few years. They have gained market share. They have taken away market from VIP, and more importantly, they have also grown in terms of profits. VIP has lagged behind, and I think it's also had to be do with the leadership issues, etc. So management change is not necessarily bad. So I think if a management is not performing and they are losing market share, they are not able to meet the guidance which they gave on a continuous basis, then it makes sense for the board to replace. In many cases, we've seen management changes could turn out to be positive for the company. So I'm positive on this management change per se. VIP, I obviously track quite closely. I think last quarter could have seen a bottom in terms of its margins, etc. Things could improve going forward, and that's what is getting reflected in the price movement after the results.
What about, since we're talking about urban consumption and urban discretionary, what about Bata and the rest of the footwear companies? Of course, Bata today is seeing quite a bit of spike of around 6%. But what's your view?
See, Bata cannot be compared with most of the other footwear companies. It has a space of its own. again, here it's an interesting story because I think they have got into new spaces. Their sneaker segment is doing well, athletic, leisure, clothing segments they have got into. And there's news flow of some tie-up with Adidas, which we don't know whether it will happen or not. But if it happens, it could be a significant positive. Overall, I think here also in terms of Bata, the performance seems to have bottomed, and from here on, I think things will only improve. So it's an interesting story. It's not very cheap in terms of valuations. X of any deal with Adidas. If some Adidas kind of deal happens, then the valuation paradigm might completely change. So I think it's a company which I think definitely should be on the lookout.
Well, for now, Bata is clearly one of the star performers. In fact, Somit the other day was, culling out some interesting data about the maximum or highest EPS upgrades that one has seen in Q1 FY24 and the highest EPS downgrades that have also come in. Let me quickly take it across to him, get in all that analysis first.
Well, what we have done here is we have compared the FY24 EPS post the earnings season, what has been the upgrades compared to what the numbers were before the earnings season started. Now, what we're understanding here is that Zomato and PB Fintech are the only two companies that have seen a more than 100% rise in their FY24 EPS, which means that their FY24 EPS has been upgraded by more than 100% by analysts. Now, this could be on the back of the fact that the Zomato reported a profit in the first quarter of FY24 and PB Fintech's losses were on the lower side. Along with that, there is LIC, HPCL, BPCL who have seen an EPS upgrade of around 29 to 44% on the back of strong first quarter numbers. Indigo reported its highest ever quarterly profit, and hence if you see the company's EPS has been upgraded by around 25%. Then there is Tata Motors, Seat, Suntech Realty, Lemon Tree which have seen an EPS upgrade anywhere between 18 to 24% post the strong Q1 numbers. Now on the negative side, to everyone's surprise, chemical companies are not on the top of the list. There are very few chemical companies like Sudarshan Chemical and Gujarat Fluoro on the top 10 list who have seen an EPS downgrade of around 22 to 26%, but it's V-Mart which has seen the biggest downgrade in their EPS of around 88%. This is after the company reported a surprise loss in the first quarter, while the outlook also continues to remain a bit sluggish. But then there is Sagar Cement which saw an EPS downgrade of around 29%, largely on the back of their high cost raw material and because of lower pricing power. Then there is Nykaa which have seen an EPS downgrade of 27%. Mahindra Logistics has seen an EPS downgrade of 23% because of delay in its integration with Rivigo. Along with that, there is Healthcare Global and Laurus Lab which have also seen an EPS downgrade of around 18 to 20% because of weak outlook and weaker first quarter FY24 numbers.
Okay, so that's the take coming in as far as the big upgrades and downgrades are concerned. But time now to slip into a very short break. But as we do that, listen into the latest commentary coming in from Nilesh Shah of Envision, because he pointed out a lot of stocks that they're still betting big on.
The way I look at IT, and I'll probably slightly cast a more long-term perspective. I think the big boys in IT, I think they are great capital efficient companies, but they're going to be relatively moderate in terms of their growth rates. No matter how great the opportunity is.
The size has become large for them.
Their size has become so big that I think it's going to be hard for them to kind of grow in double digits. Even if you look at, say, an Infosys or a TCS, the last 10 years, and in last 10 years, so much of technological advancement has happened, they have grown at probably 10, at best maybe 12% in terms of the revenues and maybe 13-14% in terms of earnings. Now that's not bad, it's good, but they're not necessarily those hyper growth stocks. So currently one company that we've just recently invested in, we own it, is essentially MapMyIndia CE Infosystems, which went public I think a year and a half back. I think so again, coming back to technology, I still think that there are several opportunities in the broader market. I think if you take your eyes off the top 3, 4, 5 names and look at maybe some of the other companies, I think there are interesting opportunities. LTTS is something which we continue to own. Newgen is something that we have liked, and I think it's a very interesting company also. So I think for now, I think we have these 3, 4 such kind of companies which we believe have a very good runway of growth, but I think we keep scouting out for opportunities there.
back with closing trades right here on 80 now. Let's just revisit where the closing trades are settling in at. 19,376 is where we're currently at, a dip of about 0.5%. This after a quiet start, but we were unable to hold on to that flat move soon after we did dip. ITC, that's a big drag today. It's down about almost 2.5% as we speak. Tata Motors, L&T, Reliance is down 1.25%. And then, of course, you've got the IT majors as well. After a bit of a respite coming in yesterday, once again, they are down and out. So TCS, Wipro, they're all in the red as we speak. Even Infosys, which was a big mover yesterday after that deal that they got of about $1.6 billion from LG. That said, Sandeep, wanted to get your opinion because, you know, the street seems pretty divided on whether or not to start buying IT at all. And, I mean, you know, we had Nilesh Shah from Envision Capital, for instance, this morning, and he said that it's not going to be India's decade, but decade. And Indian IT will be able to transform and catch up with the AI trend. But then again, a lot of the street is still a naysayer and still away from IT.
The technology sector has a very diverse universe these days. So there are some companies which are specific into some particular set of industries. So they might actually do well catering to defense, or some companies into, let's say, the travel industry here and there, or some companies doing work on more on AI, EVs, etc. So I think X of that, if you ask me for the broader technology space, I think things will still be tough. So I think for the larger companies who have a much more diversified client base and business, it's going to be tough because the business is still slowing. These sporadic deal announcements, I don't know why these companies are doing them. I think it's more to do create some positivity around them. But otherwise, directionally, as we saw in the results which just came out, and the overall trend which we are likely to see over the next 2-3 quarters, things are still going to slow down.
Enough, but let's talk about some of the price volume buzzers as well. Wanted to highlight Birlasoft in an otherwise weak market. That's hit a 52-week high on an intraday basis. It's been advancing for 5th consecutive month, and the volumes today are 2x of the usual average that we have seen the stock holding up with a gain of around 4%. Bata India, as we just flagged out, that's showing a U-shaped reversal. It's breaking out from a 4-session consolidation, surpassed the 50-day moving average, and the volumes are 5x of the 20-day average that we have seen. So Bata India sitting pretty with a gain of around 6%. Escorts too has hit a record high on an intraday basis. It's been advancing for 5th consecutive month, and the volumes are on the heavier side as well. Naresh, your view on a couple of these counters, Bata India, Birlasoft, Escorts, and even let's add REC for that matter. Any of the stocks that you like from this list?
So watching out for Bata India because today is a big volume day reversal. But it has taken resistance around that same recent highs of 1770 odd, not able to sustain those levels, but could be interesting if it sustains above that 1770, 1800 mark. REC has been in a very strong trend, tough to actually get in at current prices because the risk rewards don't really fit in to the stock, but the trend continues to remain positive on REC. So would wait for a dip on REC to participate, but Bata could be something on radar on dips to 1700 or above 1770, 1780 levels.
Sandeep, where will the market get its next set of triggers from? Given that earnings are now behind us, that seems to be well digested. You think inflation in the near term and more what we hear from the central bank with regards to ICRR, which they said they're going to be reviewing on 8 September, is that going to act as a trigger?
See, I think the weakness in the market has nothing to do with what RBI has done or ICR. So I think that's not the real thing. The real thing is what's happening globally. So we have seen globally markets start to weaken. We have seen what's happening in China. We have seen what's happened to bond yields and the US dollar index. So it's more to do with that. And as those things stabilize, as the markets give up some of its gains from the top, then I think in any case, the longer term outlook still is positive for equities. So we'll again start buying coming in. And the broader universe in any case is not doing badly. I think like you yourself were quoting some of the stocks right now, some at 52-week highs, some rallying. So it's not that the overall market is doing badly. It's just that where there is FII concentration, we are seeing some selling because there are outflows, which could continue for a few more days.
Rudra, I just wanted to ask you about ITC. That's seeing quite a bit of weakness today. Is it the time to probably book out profits or time to get into that stock? And a couple of these cement names, India Cement, JK Cement, seeing quite a bit of selling pressure.
See, ITC has very strong supports at levels closer to 430 to 435 range. In fact, I will definitely not sell ITC here. Rather, another 5-10 rupee down closer to those levels of 430, 435. I will be a buyer in ITC. The medium to longer term trend is very much positive, and only if you are a very short term trader, yes, you should have booked profit at higher level, not now closer to support. So I will buy ITC rather than exiting or selling at current level. Look at India Cement, another stock. This for me is in ban, but however, in F&O, lot of positive action has been seen in India Cement, and at current market price in equity, it can definitely be a buy. And for me, this stock has given a good price volume action on the upside, and it has also given breakout above levels of around 235. So any dips to those levels will now act as a strong support zone, and stock is headed towards 280, 285 kind of a level. So I will be a buyer in India Cement, looking at targets of 280, 285, and keep a stop loss of 230 for this long call. India Cements looks very, very strong.
Coming in on India Cements, was just scanning the list of the highest EPS upgrades, which Soumya just highlighted a short while back, and Zomato is clearly topping the list with almost a 111% EPS up move that most brokerages seem to be hinting towards. PB Fintech, a far second with I stand corrected. It was actually LIC, which is a far third. 44% is the EPS headroom that most brokerages are penciling in. PB Fintech with 102%, and then of course there's HP, BP, Interglobe Aviation, Tata Motors, etc. as well. But Sandeep, you think most of the rally in Zomato and PB Fintech is done with, or do you think there's still a good buy at these levels?
PB Fintech is no story, so I don't know what creates excitement out there. So I think sporadic things will be there, but they don't have any more to speak of. But Zomato definitely is a good longer term story. Now, at what price we should be buying is always a debate. Because the price at which it should have been bought, I personally didn't buy, and now the stock's up at $90. So I think $90 it takes into account most of the near term positives. The management has given a very aggressive guidance for next year. If they are able to meet their guidance, then I think the stock will still go higher. I would think that in this kind of weak consumer environment, meeting that kind of guidance which they have put out is going to be very, very tough.
That's the take coming in on Zomato and PB Fintech. Sandeep, good to have you on the show as always. We'll let you go on that note. Let's take in some closing trade ideas as well. Rudra, what's on your list?
I'm going with two sell calls, both on private banks which are weak. One such call is AU Bank. So for me, this stock has definitely not participated in any rally when banks were actually rallying, but this stock is just moving on the downside. So at current levels, I will short available in futures. So one can sell AU Bank looking at initial targets of 675, and eventually it can even come to 630 zone. Keep a stop loss of 710 if you are shorting this in future. I have a second sell call on Indus India Bank. Strong support at 1400 is already broken, and stock is decisively trading below this level. One can again definitely positionally go short on Indus India Bank. Available in futures for you to short. Sell at current market price or any bounce to 1400. Keep a stop loss of 1405 and look at initial targets of 1350 to come on Indus India Bank.
Okay, so that's the take coming in on IndusInd Bank. But Naresh, what are your closing trades?
So that would be a buy on Axis Bank, a risk-reward trade here. The stock is holding on to that 930, 940 mark for the last 2 weeks. If it sustains, we could see a bounce back towards 955, 960 levels in the near term. With the stop loss at 935 looks a decent trade.
That's the trades coming in. Axis Bank is the one that looks good to Naresh on these levels. Time now to slip into a very short break. But as we do that, pull up the chart of Mahindra Holidays. That's seeing a sudden spike as we speak. Rate gain is also doing quite okay. Yesterday it was Nazara Tech that was doing well. Latent View is the other one that has been holding out quite okay. Actually, Mahindra Holidays has seen a big spike. We'll wait by and see what the news flow is on that one. But a lot of these counters are actually doing quite well from the broader markets. We'll discuss these and a lot more stocks when we come back. welcome back. Let's just highlight some of the big buzzes as well, because it's the last 30 minutes of the trading session and it's the day of the weekly options expiry. So on the losing side, there are stocks like Suprajit Engineering, which is coming under pressure. RFCL is down almost 6%. Nava is down 5%. Utkarsh Small Finance Bank, for which the IPO lock-in, anchor IPO lock-in has actually ended. So that stock is seeing a cut of almost 5%. On the gaining side, as I said, there was Mahindra Holidays, which was perking up. Latent View has had a solid run of 8%, and then there were some other names as well that were perking up in the last few minutes, and not to forget Adani Ports, which is sitting with a gain of almost 4%. We also have Shibani Sarkar Korean joining us on the show to talk to us about the fundamentals. She's of course joining us from Kotak Mahindra Asset Management. Shibani, hi, thanks so much for making time speaking with us. What's your market view? Because it just looks like it lacks skew, it lacks momentum, there is no interest in the market at this point of time. Do you think it's just transient on account of the earnings season just getting over, or this is likely to be the case for at least a month or so?
Hi, good afternoon. So now the earnings season is behind us. So if you look at what's happened in the earnings season, clearly numbers overall were in line with estimates or marginally ahead of estimates. So earnings delivery has been fairly good. And therefore, if you look at FY24 and FY25 estimates remain fairly buoyant and resilient. So for Nifty, the earnings expectations are in the mid to high teens earnings growth for the next couple of years. So on the earnings side, we are fine. However, I think the key issue with the market at current levels is that valuations on an absolute basis are now above long-term averages. And to that extent, in the near term, there could be some degree of volatility. And therefore, earnings delivery now becomes even more crucial for the markets to sustain at these levels or move higher. The good part, however, is that on a relative basis, our valuations are not as stretched as what they were earlier. And therefore, on a relative basis, India's valuation relative to the emerging market context continues to be somewhere above long-term averages. So therefore, while there could be some degree of volatility in the market at this point in time, the downside doesn't seem to be a very sharp downside risk at this point in time, given the kind of valuations that we are trading at on a relative basis. So the way we are approaching the markets is that when you're looking at earnings delivery, we are trying to look at pockets where earnings growth seems to be resilient. And from that context, our positioning continues to be more towards the domestic-facing sectors, where we believe that earnings delivery is possibly likely to stay fairly robust.
Shibani, I guess a lot of it applies to the defense space as well, because, while these stocks continue to hit all-time highs and the news flow continues to be positive, but time and again, one thinks that the run-up has been too steep, the valuations are looking ripe, and one should stay out. But then again, you have news flow as strong as, Germany and Spain contesting that near about $5 billion deal for Indian submarines. And look what it's done to the likes of Cochin or, Garden Reach as well.
No, I would believe that if you look at the entire industrials infrastructure space, and more specifically, as you were pointing out, the defense opportunity, the opportunity set continues to remain fairly large. Yes, while in pockets that valuations have moved up, but specifically to defense, one, of course, the domestic defense opportunity from the indigenization story that is playing out. And the second, as you were pointing out correctly, is the export opportunity, which is still fairly untapped. And therefore, the overall growth segment and the runway for growth where defense is concerned seems to be fairly intact. Also, if you look at slightly on a more broader basis on the industrials, infrastructure, manufacturing side, what we have seen is that in the recently concluded earnings season, the order inflows have remained robust, and that has been the trend that has been seen over the last few quarters. The second aspect is that, when you look at this entire space of industrials, while a lot of the growth has come in through in terms of public capex, overall, if you look at data in terms of the headline capacity utilization levels in the economy, that number has moved up above long-term averages. And therefore, our belief is that private sector capex should also start to pick up pace. And within this entire construct, defense continues to remain a fairly interesting opportunity.
Naresh, your view on a few of these buzzers. There's a Power Industries which suddenly spiked 12%. Latent View has been holding high by 7 to 8%, and then Mahindra Holidays which saw a bit of spike.
So APAR is seeing a very, exponential move. This would be the right time to actually book out. Could be a topping out case, could be flow-based or ETF-based, seeing the move in the last 30 minutes. So would avoid it as of now. Mahindra Holidays Resorts looks interesting for the fact that the stock at 340 is crossing the highs made in 2017. So it's almost a 5-6 year breakout. So looks very promising if one has a little medium term outlook. Eventually the stock could go towards 450 levels. It's a buy at current levels as well. And we are seeing good momentum across the hotel space. We've seen Lemon Tree also coming close to a short term breakout. So there could be some momentum in Mahindra Holidays as well as Lemon Tree.
Okay, that's the take coming in on, some of these buzzers in trade. Bata continues to hold out, Chambal Fertilizers, Birlasoft, REC, Adani Ports. It's an interesting mix out there. And, like we've been pointing out, you can't really pinpoint any trend here. While, of course, the takeaways from REC's analyst call were very positive. They're looking to be net zero NPA by the end of 2025, saying that they've not added any new NPAs for the last 6 quarters and that they are expecting the NIMs to be in the range of 3.5% for the full year as well. Shivani, power and the ancillary space, anything that interests you here?
Yeah, so this is an interesting segment. Now, while structurally a lot of the concerns that are there from an ESG or climate risk perspective are very real. However, what we are really seeing is that, if you look at many of the companies, the strong performance is on the back of a structural demand tailwind and the demand supply imbalance that is there. So what we've also seen is that while there is a thrust on renewables, the kind of structural demand growth is there in the system will not be met only by renewables, and therefore thermal or coal capacity additions will also have to go hand in hand in terms of the capacity additions on the renewable side. So from that construct, power as a sector continues to look fairly interesting at this point in time. Within the sector, at this point, we prefer the GenCos over transmission and distribution companies, but overall the demand supply dynamics within the sector means that while the transition that we are making because of ESG or climate related risks will happen, but it will happen over a period of time. And in the near term, thermal as well as renewable capacities will go hand in hand.
Taken. Rudra, what about JM Financials? The volume is almost 7 times the average volume that we have seen. Home First, which is expected to be a big beneficiary of the urban development scheme. And then you also have names like Amber Enterprises, which are doing quite okay. The stock was pretty much sideways for a lot of time. The rest of the EMS pack had run up, but Amber was fairly quiet. Now it's seeing quite a bit of spike today.
See, for me, JM Financial is the best among the lot here of the stock names what you have mentioned. This stock also offers a great risk reward. Levels closer to 70, 72, it has a very, very strong support and it's a clear buy at current market price. I will keep a strict stop loss of around 70 and initially one can look at target of around 83, 85 to come. And once the stock breaks that range of 85, further up move can be seen on the stock. So JM Financial looks very strong. And if I have to look at Amber Enterprise also, so this stock again for last 3-4 days is showing a clear positive price action. And for me, this stock on any dips to levels closer to 2,500, 2,300 is all a buy. I'm only worried on the very quick and swift move which it has given. So if I have to buy at current market price, then I will buy 50% of my quantity now, and on any dips to levels closer to 2,650, 2,500, I will add more. And the Amber also looks very, very strong to me. So it's a clear buy.
Right, okay, that's the take coming in on Amber, which is looking like an interesting buzzer. Just want to take stock of what some of the Adani names are doing, because that's really lifting, the market, and they are one of the key movers amidst the large cap. So it's pretty much Adani Enterprises and Adani Ports, which is now higher by about 4%. There's Titan as well, which is not looking all that bad. And then there is Bajaj Auto, which is also holding out 1% as we speak, although Bajaj Auto has had a pretty much choppy ride, started off quiet, dipped into the red, again bounced back, saw a deeper dip, and then from there it's seen a meaningful recovery from the session lows, that is. Shivani, wanted to get your thoughts in on how you think the two-wheeler space is going to pan out. We were just chatting with Ola Electronics Bhavish Agarwal, and he was suggesting that that very soon the entire two-wheeler space is going to be EV and that ICE age is pretty much behind them. But that, of course, was, a view coming in from one of the two-wheeler EV manufacturers. But, the kind of stiff competition that is building up even in the ICE engine space within two-wheelers, how do you think this entire space is going to pan out?
So, the debate on the two-wheeler side in terms of EV versus ICE continues. However, remember, a lot of the EV penetration or the growth that we have seen has been on the back of the subsidy support that was given. And therefore, in light of that, we would also believe that going forward, while EV penetration will increase, there is still space for the ICE engines and in terms of the two-wheeler space. Now, two-wheeler as a segment has been one where recovery clearly has lagged the PV segment and the passenger vehicle segment. But at the margin, what we are seeing in terms of, on the ground feedback and even in terms of numbers on a monthly basis, is that the demand trajectory from the rural markets appears to be improving. So that's one possibly an important factor, especially where the base or the lower end segment within the two-wheeler category is concerned. Now, where the premium two-wheeler segment goes, there has been stiff amount of competition, so there has been a slew of model launches. However, there the demand continues to remain healthy. There may be market share shifts, and therefore you have to identify players which clearly benefit or gain market share within the premium segment. And therefore, those companies which have model launches where we need to monitor the kind of demand growth that is taking place may possibly emerge, winner in that segment. But overall, within the two-wheeler space, we believe that valuations remain fairly comfortable. This is also a segment which will benefit from a margin perspective. And as volume growth recovery takes place on the back of rural demand starting to improve and some of the replacement demand which has been absent also starting to kick in, this space seems to be fairly well placed from a slightly medium-term perspective.
So the ICE engine versus EV debate will go on, but most likely they'll go hand in hand. It's not going to be a complete EV transition at this point of time. But in the meantime, what's the chatter around in the dealing rooms and which is the stock on their radar? Sharad is joining us with the latest.
Well, yes, in focus we are having Jubilant Ingrevia, and what we are hearing from the dealers is buying seen from the DI counters as well as certain HNI counters. Now, looking at the stock itself, the volumes has gone up almost 4 times its 20-day average, and on a technical basis, the stock is just 1% away from its 200-day moving average. The stock itself is up 11% from the July lows itself, and the key DIs who are already invested in the company, they include the names such as Nippon Mutual Fund as well as DSP Mutual Fund. The Q1 numbers recently had come and the numbers were largely weak, and the management did state that the Q1 FY24 numbers would be largely weak because of the muted global agrochemical demand. But there is a sliver of hope, and 2 important short-term positive triggers are coming from the stock. The first one being the nutrition and the health segment. That segment is seeing a strong volume recovery, and also a good traction is being seen for the CDMO segment for the business.
We leave it at that. Sharad, thanks for highlighting what's buzzing with Jubilant Ingrevia. That stock, almost 1 million shares traded and buzzing about almost 5% as we speak. So that's pretty much holding out very, very smartly in trade. Naresh, I don't know if you've been seeing the charts of Jubilant Ingrevia or not.
So not tracking it closely as such because the stock was pretty sideways for a long time. But would wait for some more time, let it sustain for a few sessions. The stock has corrected from 800 plus. So would wait it out, let it say settle for another couple of sessions and then maybe look at it.
Point taken. Shibani, but a couple of stocks which are coming under pressure are also from cement space right now, whether it's an India Cement or a JK Cement, etc. What's your view on the cement pack as a whole, and is there any stock from this vertical that you would suggest as a buy?
So, from a sector perspective, we continue to remain fairly positive on cement. What we have seen, especially in the quarter gone by, is that the volume growth has been very, very strong. Of course, pricing has remained muted, and that has been the elusive factor in this whole equation where cement companies are concerned. The overall impact or the positive impact because of input cost pressures coming off is likely to flow through in the next few quarters as well. And therefore, we do see some amount of improvement on margins coming through because of lower input costs. If pricing holds out and if over a period of time you start seeing some improvement on pricing, that will impact the overall profitability and be positive, because pricing is one of the key factors which drives profitability in the sector. The other most important and a slightly more structural thing that is happening in the sector is clear a degree of consolidation, and therefore there is market share shifts towards a few large players, and that should also bode well from a profitability perspective on a slightly longer term basis because of market share shifts and consolidation. Now, cement as a sector continues to be one of the best proxies to play for infrastructure as well as the entire real estate housing construction side. What we have seen is that, in terms of the overall balance sheets across many of the companies, balance sheet has seen improvement. There is going to be some degree of capacities that will come up over the next few years. However, as long as demand stays strong, the capacity utilization levels also can stay high and elevated, supporting profitability. So this is a segment where we continue to remain positive.
Sure. Okay, picking up on an ET Now exclusive, in fact, we understand that the government may actually bear the entire cost for giving that 70 lakh new LPG connections. In fact, we are learning from our sources that the Finance Ministry is considering a proposal from the Oil Ministry to give 100% subsidy for new LPG connections. Prakash Priyadarshi, my colleague, joins in, and he says that it will be a big relief for OMCs who are bearing 50% of the cost currently. Prakash?
Yes, we are learning from our sources that the Finance Ministry is considering a proposal to grant approx rupees 4,000 crore to provide 70 lakh new LPG connection to the consumer. We are given to understand that the Oil Ministry has prepared this proposal and sent to the Finance Ministry for its consideration. Expenditure Finance Committee of the Finance Ministry is evaluating this proposal at this point of time. Since connections will be given under Ujjwala scheme, we are learning from our sources that the Oil Ministry has made a proposal to change in existing structure of the Ujjwala scheme in order to provide relief to the oil marketing companies like IOCL, BPCL and HPCL. As under new proposal, oil marketing companies will not have to share the cost of a subsidy burden with the government in a ratio of 50%. So that's a big relief when it comes to oil marketing companies. As per the proposal, government will bear 100% cost of the subsidy under a new scheme. Moving ahead, sources are also informing that government may also increase the cost of a connection under a new structure. That may be increased from 3,200 rupees to 4,300 rupees per connection. So it's a big development coming in. Apart from that, when it comes to consumer, sources are also informing that under new structure, consumers will also get a big relief as they will not have to pay EMI to the oil marketing companies in order to get new connections. So this proposal is with the Finance Ministry for its consideration, and sources are informing that the Oil Ministry will approach Union Cabinet for its final approval after EFC nod.
Okay, so that's the latest coming in. Thank you so much, Prakash, for joining us with that. But before I come to Naresh for the BTST idea, I wanted your take, Rudra, about the Adani group of counters. As we were talking about, that's the only space which is holding up, whether it's enterprises or ports. Is there any name that you would recommend at current levels?
Yeah, I would definitely put Adani Ports charts much better to that of Adani Enterprise. So if you want to buy an F&O stock available in Adani Group, I will definitely go for Adani Port. I will keep today's low as stop loss somewhere closer to those levels of around 780, 770, and look at targets closer to 830 to first come. And then it can eventually move towards that levels of around 870 to 900. So I will be taking Adani Port long call with a strict stop loss of 780.
Long call on Adani Ports, but what's the long or short call that, Naresh, you have as a BTSC trade?
So two large caps, a buy on Axis Bank with a stop loss at 935 and a target price of 955. Second is a buy on Mahindra and Mahindra. The stock is just say a percentage point away from an all-time high. Stop loss at 1555, target price of 1620.
Okay, that's the take coming in on some of these BTST trades right now. Shivani, before we let you go, just wanted to understand, where is it that you think that the market is overvalued? And I'm talking about various sectors here. And where is it that you feel that if we were to correct a little bit more, they would get into value zone?
Yeah, so the way we have been approaching the market has been to look at as we have discussed earlier as well, that look at domestic facing sectors and businesses where you are seeing growth and earnings trajectory remaining fairly intact. So at this point in time, of course within sectors there are different pockets of valuations and opportunities. So sectors where we continue to remain positive include industrials, auto, cement, and banking. Now, within banks, if you look at the way the entire segment has played out, the larger private banks, despite the fact that they have seen improvement in terms of profitability, have not seen multiples re-rate. And therefore, their multiples remain at long-term average levels despite seeing significant improvement over the last couple of years where return ratios are concerned. So that is one segment where valuations appear to be in your favor. The other sector where we are currently underweight, where there has been significant amount of impact because of the global growth slowdown, has been the technology space. But within technology, mid-cap IT clearly seems to have run up significantly and are trading at multiples which are higher than their own long-term averages as well as higher than the large cap space. So the mid-cap IT sector where valuations are clearly not in your favor, that is one segment we would be a little cautious on, while large cap IT seems to have more valuation comfort. And therefore, as and when over the next few quarters you start seeing some stability or improvement in terms of the growth trajectory, that could be a segment that we could evaluate. But at this point in time, we remain somewhat cautious on the entire IT pack.
Bit cautious, especially on the mid-cap IT universe. But Naresh, from the PSU banking space, what would be your top bets?
So if you look at it, it would be Punjab National Bank (PNB) because that's the stock which has been a major underperformer for a long period of time. The stock is coming back to the same prices where it topped out last year. Sustaining about 64, 65 would be a major breakout. Expect it to be sideways for some time, but eventually a breakout about 64 and go towards 75. So the top bet right now would be PNB.
So top bet within the public sector banking names is Punjab National Bank, and today in fact if you look at an Indian bank, a Bank of Baroda, an SBI, Canara Bank, they're all flying away in the trading session. So that's just one end of the market which is actually holding up in the green, because apart from that, most of the sectors, whether it's energy, FMCG, media, IT, they're all on the back foot. Realty is just managing to show a bit of a strength. So Sobha, for instance, and a Brigade and a Lodha are trying to hold up in the green, but the momentum still is a bit sideways when it comes to this pack as well. But the urban consumption themes, Shibani, that's been working out very well. And the premium category at that, a Sula, a Landmark, a Lodha in terms of real estate, and even PVR Inox for that matter, which is doing quite well after Gadar's release. Is there any of the verticals that you would want to bet on when it comes to urban discretionary consumption?
Yeah, so the urban discretionary consumption continues to hold up well. And as you rightly pointed out, the premium category seems to be the one which is doing well. While the mid segment, where, some pockets, we've seen discretionary consumption actually slow down. So be it pockets of retail, the lower end in terms of footwear. So there are pockets, especially at the lower end, where consumption slowdown has been very, very prominent. Now, within the consumption basket, at this point in time, our preference has been slightly more tilted towards the staples and the FMCG side, where we have started seeing some initial signs of volume growth recovery. Secondly, margins clearly have expanded, and that expansion in margins is likely to continue. Some of that margin expansion will flow back into in terms of higher ad spends, etc. But overall, there is an expansion that is taking place from a margin perspective. So what we believe is at this point, if you look at the entire consumption space between discretionary consumption, where valuations are somewhat elevated, vis-a-vis the staples pack, where valuations, while on an absolute basis may look elevated, but compared to its own historic averages, valuations remain relatively well placed. So our preference at this point in time at the margin has been more towards staples rather than the discretionary consumption pack.
Right. Okay. Shivani, great to have you on the show. Thanks as always for taking the time out and joining in. Naresh, before we wind up for the day, just a quick strategy on where you think the Nifty could be headed next.
So the view is we could bounce back towards 19,500, 550.
Okay, 19,500, 19,550 on the cards. Seems like this consolidation and a little bit of dip down is only for a way forward. Rudra as well as Naresh, both of you, thanks as always for joining in. Let's begin winding up for the day. And we're closing in sub that 19,400 print, 19,350 thereabouts is where we're shutting shop for the day. It's really been the Adani names which have hogged all the limelight after GQG acquired that 8% stake worth about 9,000 crore rupees in Adani Power in blocks. So that's one stock which was in focus today. And of course, Adani Ports, Adani Enterprises, the entire cluster held out a buzz in trade. JSW Energy, let's revisit that one as well because there too GQG has been a buyer. That stock was down about 4% in today's trading session. As were Religare Enterprises in focus yesterday. Berman family bought about 5% stake via blocks. And today the stock was a little soft, down about 4% is where it's shutting shop for the day. The other big buzzers, of course, have been Bata with all the news flow given an M&A kind of a deal that's maybe in the works, seems to be doing the rounds. So almost a 6% dash is what you saw on Bata at the intraday peak. REC after the brokerage upgrades and the con call takeaways. Almost a 5% bump up on that stock as well. Birla Soft, Chambal Fertilizers, Bajaj Auto, SBI and Titan. These have been some of the big buzzers in trade today. On the flip side, weakness for ITC down about 2.5%, L&T down 1.25%, Reliance as well under pressure, TCS, Wipro, ICICI Bank. It's these heavyweights which have pulled the markets lower in trade today. But on that note, we're going to wind it up on this edition of Closing Trades. Thanks for watching.